You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. If you trade options, you want to be smart about every decision. So why not choose the smartest platform for your trades? At public.com, you can view upcoming earnings dates directly in the options chain. You can queue and execute multiple orders simultaneously. Easily view contract performance over time. And if you have a question about any stock, you can ask Alpha, their AI for investors. But want to know the smartest part of trading options on Public? Earning rebates on every single contract traded. No other platform provides options trading rebates, and they reduce your trading costs to less than $0 per trade. So, make the smart move and switch to Public.com, the only options trading platform where you can earn rebates on every single contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means it's back. Time to hold court once again on a little bit of Education Wednesday. Yes, it's time once again for Options Boot Camp, the premier, yes, I said it, the premier options educational program. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you folks are mainlining these days. Fun times coming at you from the heart of Chi-Town here these days. So intriguing times to be in downtown Chicago, to put it mildly. City's been kind of transformed into a walled fortress. So we're hanging out here. We're fighting the good fight, still getting the content out to you, keeping the content flow coming. In fact, did an early bonus little pro Q&A for you folks right before this show, which is kind of fun because we weren't sure just how much live time we were going to be able to have on the network this week, given all the madness unfolding right outside our doorstep these days. So intriguing stuff, but we are still up, running, and rearing, and ready to go. Of course, you're listening down the road, months, years down the road. None of this will mean anything to you. But we are recording this, of course, in the middle of the DNC here in 2024, which is right about a mile down the street. And, of course, all the fun has been popping off about a block or so away. So intriguing times to be here in Chi-Town. And if you want more intriguing times, you want to get access to that cool pro Q&A/AMA we were just talking about here that went live right before this episode. You want to get options oddities every Friday. And trust me, been some bangers of late on options oddities. You want to be in on those. Only one place to go, theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us on the old program today, I'm pleased to say he is keeping his streak alive. The black-hatted one himself, Mr. Dan Passarelli, once again joining me now for our 302nd episode spectacular. Mr. P, have you recovered from the 301st episode spectacular, sir?
I have, and I am ready for 302.
All right, let's do it. By the way, before we get there, if you like what you hear, throw a like, a star, a comment on whatever platform you get the content. All of that does help people, and they are legion these days. Continue to discover the content. Just like this week's 5-star review comes from Evan Thompson. He says, great host combo, good info, 5 stars. Well, you know what? I give that review 5 stars, Evan. Thank you for taking the time, and everyone else takes time out there to rate and review. We do appreciate it as we keep on rolling right on into a little bit of options drills.
Holy mooch! Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, let's get down to business. And today's topic kind of goes a little bit between basic training and a little bit of option drills. Kind of falls in between because it's a relatively basic option strategy, and yet the use case for it these days kind of interesting. What am I talking about? Well, I'm going to revisit. I wasn't planning on doing this, actually, but Dan, as he is wont to do, hijacked the show yet again with his own flow of content over there from MTM. What are we talking about this week, listeners? The beloved / much maligned straddle. Now, you know, we here on the show have joked about these and talked about these many times over the past 301 episodes. Usually not huge fans of doing straddles in most scenarios. It really takes some aberrant scenarios to make us stand up and say, you know what? Might be a good time to buy some straddles. Back in the banger days of 2021, late 2020, there were some times there where straddles were really paying off. But those times are few and far between, which is why, Dan, it kind of caught my eye when I saw out there on your Market Taker newsletter, and you folks should be checking it out over markettaker.com. Don't forget the second T for Theta. You put out a video just, I think, on Friday saying, I think, to quote you now, straddles are your favorite strategy. Everyone should be buying straddles, I should say. Put all your money into straddles. Wasn't that the title of the video? Put all your money into straddles?
That was, I wouldn't say you paraphrased that perfectly, Mark.
Pretty darn close. Pretty darn close.
Or, yeah, well, okay. So, well, I did talk about straddles, and I did point out that there are some select opportunities where straddles are drastically overpriced, and I've got a lot to say about that. We'll talk, I think, throughout most of this episode about it. So, yeah, that's what I want to talk about today.
As Larry David would say, I think I did pretty good on paraphrasing you. Almost, I mean, it was almost verbatim. I mean, if I could have done it in your voice, Dan, it would have been exactly what you were talking about. Let's get to it. Let's just get right to it. I'm going to make it the Dan show. I'm going to step away for about 20 minutes, let you hold court on all things straddle, because it was kind of interesting. I did not expect you to throw down a buy some straddles video towards the end of the week last week, which is, again, why you gotta pay attention to the MTM newsletter. So let's start there, Dan. Why are you so giddy about buying straddles right now?
So, well, let me tee it up and go backwards. I'll give you the prequel first here. You've heard Mark and I talk about volatility in the past on this show. And the one thing that we both talk about, because it's pretty black and white, it's like math and science, is that since 1987, options have been, you know, like overall, statistically on average, overpriced. And that's where you get a lot of people who say, oh, the only way to make money in options is to sell them and things like that. And of course, when Mark and I drill down on that kind of thing, we kind of like to caveat that a little bit, that sure, if you are not allowed to do any research, you're not allowed to use tools like option charts and implied volatility in your option chain. All you can do is, like, you know, wear a blindfold and fumble around your keyboard and, you know, There's one braille for the buy button and one braille for the sell button. You're going to win more if you hit the sell button overall. But if you are able to do research, you have access to volatility charts. You have access to implied volatility of specific options in your option chain. You can see what the historical volatility is, what the implied is relative to itself over the past few months. Then you can actually analyze and break it down and say, well, although implied volatility is statistically on average somewhat overpriced, right now it's not. And then you end up being a lot more sophisticated. You have a much more powerful set of tools, and you can trade a lot more scientifically, mathematically, left-brained, more like a professional. And guess where this is all leading to? Yes, that's right. Right now, we are seeing a time when implied volatility actually is underpriced in a lot of different names. And it's kind of weird why that is. And this is one of the nuances of the market that you don't see very often. But when you do, it's glaring that it doesn't make any sense, and it gives you an opportunity to put on a statistically advantageous trade. So when stocks go, okay, so like what is implied volatility? It's basically the supply and demand measurement of the option prices. And in measuring that supply and demand, we assume that people make decisions on whether to buy or sell options based at least somewhat on their expectations for future volatility. And that's somewhat true. I would maybe go as far as saying it's a little bit true. So when you have a market like we have had over the past 2.5 weeks here, where we've experienced a great deal of volatility, but it's all been upward biased volatility. The market's gone almost straight up over the past 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 12, 13, 14 days here. We've only had 3 down days, and 2 of them were little tiny bitty doji down days. You get something weird. You get historical volatility rising because volatility has increased. In fact, arguably volatility has increased pretty dramatically since the middle of July, really. Went from 17.5 to 21.5 from about July 16th to today. But what happens is when implied volatility, like when the market starts going up, people tend to start doing option selling strategies. They tend to start doing strategies like covered calls and like, hey, you know, I'm not worried. I'll do some credit spreads. I'll do some time spreads. I'll do all these volatility selling strategies. And it's kind of weird. Like it kind of doesn't make any sense. Like actual volatility is increasing, but implied volatility is going down. And now implied volatility is really dramatically undervalued compared to how much the market is moving. With a 21.5 historical volatility, which is how much the market is moving, I could go out to a 30-day option and it's like 14.5 implied volatility. It's like a third lower than arguably it should be. So that's like the first criterion that anybody should look at when they're pricing out straddles is the implied volatility underpriced or overpriced? And the second one is we just want to go and say, okay, well, if this is a 30-day option and I'm paying, you know, just call it $16 for, well, I think it's about $17 for an at the money straddle in spiders. That means that over 30 days, the market just has to move $17. Well, I mean, a week ago on 8/14, for those of you who are watching this or listening to this live, that was exactly 7 days ago, we were $17 lower. And there's a big gap to be filled there. Now, I would lean towards saying, hey, you know, I'm actually kind of bearish and expect a retracement, but the market's a freaking freight train. You can't get in the way of it. It would be kind of foolish to just say, oh, I think the market should be lower. Well, you know, it doesn't matter if it should be lower. It's not lower, and it could keep going higher. So for it to go up 17 more points is not really a big stretch either. We'd have to make new all-time highs, but would anybody be surprised by that? I don't think it should be the case based on the PE ratio of the market as a whole, but it doesn't matter if I think it should be the case. I could easily, with my mind's eye, see that happening. So, especially in over 30 days. So, hey, you know what? This ends up being just a perfect storm, one of those rare, ideal periods to buy straddles. And I'll just give you two names that are excellent candidates for it. One is SPY. I mean, implied volatility is literally like 30-some% underpriced. It should be around 21 and it's around 14. That's just insane. Very, very cheap volatility. And another one is XOXL, which is it's a semiconductor 3X ETF, which you've heard Mark and myself talk about, you know, leveraged ETFs. They're kind of silly, but it doesn't matter what it is. To me, it doesn't even matter what the underlying is. I'm just looking at the implied volatility versus the historical versus itself, you know, versus where it should be. And where the underlying was, just looking at the numbers on the chart, and it's just massively, massively undervalued as far as option prices and therefore straddles. So that one's an incredible one. Again, if you're looking at this live, August 21st, they were having the Democratic National Convention that Mark talked about. Mark's currently sitting in his front window with a shotgun, just, you know, waiting to protect his family.
Get off my lawn, I keep yelling.
Right. But, you know, you look at this and the historical volatility of SOXL is 175, we'll call it. If you look at what you can buy a 30-day straddle for, you can buy it for 100. The straddle is trading at like 60% of what it should be trading at. It's massively discounted. And if you could buy that straddle at, say, $9.50, and you look at a chart of SOXL, $9.50 away from here, what to the downside would be 33, right? 32. I mean, yeah, we were there, you know, middle of last week. And to the upside, that would be about 50. And we were there a month ago. I mean, this is one of the best straddles I've ever seen in my life. And I don't really give trade ideas, and I'm not here. That's not my job to give you trade ideas. I'm not telling you to do anything, not trying to sell you on the idea. But I'll tell you what I am trying to sell you on is I'm trying to sell you on understanding straddles so that when you see situations like this, you can identify them and say, oh, yeah, that's the thing that Dan was talking about. Wow, this is one of these really rare opportunities where straddles are drastically overpriced. Hey, there's an opportunity here. So, I'll kick it back to you, Mark. I know I was a little bit long-winded there, but I'm kind of excited about this, frankly.
No, I could tell you're all jazzed up about all things straddle. I've never seen you this giddy in quite some time. Probably the last time you and I talked buying long straddles, it might have been in those heady days of, early 2021, when I know you and Brian, everybody was all jazzed up about buying straddles. And how could you not be? Everything worked. Every straddle you bought paid off back then. There were a few moments like that, listeners. The mad days of 2020, right in the middle, kind of there, early middle time as well. But those moments are few and far between. So Dan getting this giddy about straddles, Mr. Dan. That's certainly intriguing. A really quick refresher. I know we have a lot of new people joining us all the time. Most of you know what a straddle is by now, but really quickly, let's say your old pal XYZ trading at $100, and you decide you're not really sure where the hell you think this thing is going to go over the next month. So first off, you look at the 100 strike call. I think it might go up. Trading $2.50, you say, I could buy that. And then you turn around and say, what if it drops? I don't know. Maybe I'll buy the same strike put, 100 strike put as well. Pay $2.50 for that as well. And obviously, in our example, you paid $5 now. So the downside is immediately obvious. These are expensive. Also, you're buying traditionally at the money contract, so they're going to bleed very aggressively. That's where the theta is the most pronounced. So you really need these things to kick into high gear very quickly in order for them to pay off. If you're doing it from the long side, obviously. If you're flipping it around, if you're going from the short side, you're selling each of those for $2.50. Then you got to sit on your hands and really chew your nails and pop some Tums and hope the thing doesn't move, because then you get to keep a good chunk of that $5 that you sold there. But that's your basic overview of straddles. So there you go, listener. I bet you didn't think we'd be diving into Dan doing a giddy rundown on all things straddles these days, Mr. Dan. So intriguing. I thought you were going to also say, maybe your straddles in a broad index, or maybe your Apples or your Teslas. Kind of surprising me with the underlying as well, Mr. Dan. So a two-for surprise. Well done, sir. I tip my cap to you this week, sir.
Yeah, and it's not really even limited to those. I mean, geez, I'll tell you, man, if you look at, and I do have positions on in Spider straddles and SOXL straddles, but geez Louise, I mean, this one's a little bit more tricky and speculative, but I'm looking at this and I'm kind of thinking about it right now as I'm doing this show. If you look at NVIDIA, I mean, that puppy has been moving at an 81 historical volatility. You can buy a 30-day straddle. Oh, hold on a second. Geez, this is even better than I was thinking. You can buy a 16-day straddle at 73, and earnings is before that. Earnings is the 28th. I mean, you can buy the August 30th straddle for just 87. It seems to me that in about a week or so, that's going to be trading at a much higher volatility. I mean, truth be told, it's a 41 cent theta. You lose 41 cents a day. So with an 8 cent Vega, you would have to, implied volatility would have to increase 5 points a day just to break even on theta. But honestly, it probably will. And if we go to, let's see here, earnings reports. Nope, that's not the one. Hold on a second. I got to go to my bookmarks here. Earnings gaps. There we go. If I go to earnings gaps, I go to NVDA. And you look at the gaps that tend to happen on earnings, like from the close before earnings to the open afterwards, they're kind of all over the place, which is the most dangerous earnings to trade. But on average, just kind of eyeballing it, you're going to get at least a 10% move. Geez Louise. Well, I don't think it's really reasonable to wait any longer. I'm going to just have to buy a couple of these as we're talking here. Sorry to interrupt the show here.
Likes him so much, he's buying straddles as we're talking, listeners.
Yeah, kind of have to.
How can you not? All right, listeners. Oh, ding. I think are you filled?
Yeah, I'm filled.
There you go. We're going straight. There you go. Putting his money literally where his mouth is, listeners, as he loads up on some straddles. What are your thoughts on long straddles right now, listeners? Do you love them like Dan is? Are you giddy? Are you giddy like a schoolgirl here about all things all things long straddles, or you prefer maybe to harvest some premium? You prefer to say sold to you on Dan Straddles? I'm curious. Hit us up. Let us know as we keep on rolling. Get a little bit of the old market taker question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. Dan, I know you've been talking a lot about straddles, so maybe you have more questions about straddles. I don't know, or maybe if you can pull your mind out of the straddle gutter, if you got another market taker question for us, have at it, sir.
Yeah, I kind of do. One of those questions is, actually, one of those questions is going to be for you. I'm going to answer it for me, but then I'm going to turn it around and I'm going to let our listeners contact me. Just go to our website, jump in our chat, go to our website, click join free, jump in our chat room and post in the general tab your answer to this question. But the answer is, what risk metrics should I be looking at on the trades that I make? And there are a number. I recorded a video on this. It's going to get released soon. One of the metrics that I look at is one that we don't talk about a lot, and that's allocation. And that's, if I look at the risk of this trade, which typically depends on the strategy, but often coincides with the margin on the trade. If I look at the risk of this trade, what percentage of the total net lick of my portfolio is that? And, the answer should be, it depends on the size of your account, which is probably an answer that you wouldn't expect, but it does. For accounts over 10 grand, the risk that you take on a single trade should be no more than 5%, usually between 2 and 5% of the total net lick. If you have a smaller account that starts to get a little bit unrealistic, your hand is a little bit forced and you have to take slightly bigger percentage of your net lick trades. And so that should be no more than 10% of the net lick on accounts under 10 grand. So that's one of my answers. We can talk more about this on future shows, but I would love to hear your answers to what risk metrics you look at on your option trades. So, the best way to reach me is go to markettaker.com, click join free, get in our chat room, and just DM me in there.
DM him, listeners. And speaking of hearing from you folks, let's get a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. As always, the live folks get pride of place, and people asking about the bonus Q&A I did earlier. Yeah, that's just something, like I said, it was kind of a crazy week here on the network. We weren't sure how many guests, how much we could even do live this week, if we could even get into the studio this week, because it is all popping off right outside our doorstep here. So we didn't schedule a ton of crazy pro stuff, so we thought, make it up for you. We'll go a little bit of what you folks have been asking for a while, which is just to bombard me with questions. And a lot of you did. So that was fun. If you heard us live, again, we didn't kind of just went live, so some of you might have missed it, in which case it's all there on the Pro podcast feed for you folks to enjoy at your leisure. Nearly 400 freaking episodes on that feed now. So an embarrassment of riches, if I do say so myself. And I do, listeners, theoptionsinsider.com/pro, the place to go. Queen saying, thanks for the bonus Q&A. Well, you're welcome out there. Frank asking about what's the deal with it. We just kind of went through that. Oh, Option God Dan. He's obviously a fan of yours because he says he loves hearing the noise when Dan is getting filled during the show. He looks for it. There's two things you could do on the drinking game for this show. One is when Dan takes a drink, you take a drink. And then B, when Dan gets filled. Either way, you'll get drunk pretty quick. So it's a good drinking game to play along with during the show, listeners. All right, speaking of your thoughts out there, listeners, let's get out some of the fun. We had a fun flash poll, kind of inspired by our discussion on the Option Block show on Monday, and also on Vol Views last Friday. We talked about two big prints in VIX recently. One was paper bought, they traded and mostly bought over 100,000 of the October 18 puts in VIX for about $2.15 last week. And then on Monday, someone came in and bought about 64,000, of the Oct 20 calls for $1.76. We thought equally interesting, maybe diametrically opposed viewpoints out there. So I thought we'd put it out to you. Which one of those, gun to your head, if you had to buy one, which one would you do? Dan, which way would you go? Oct 18 puts in VIX for $2.15 or Oct 20 calls for $1.76? And then B, which way do you think our audience went?
This is an interestingly posed question, Mark.
Why, thank you, sir.
Yeah. Because, 20 is high, and I think that we're definitely going to see above 20 often between now and October 21st. It's just, will it be significantly enough above 20 at October expiration to make it worth it? But I don't know, buying the October 18 puts too seems a little crazy. Not that I would sell this strangle either. Geez Louise, this is a tricky one, Mark. I guess gun to my head, I'm going to be buying the 20 calls. Yeah, for sure.
Yeah, our audience agrees with you, Dan. 60.7% going to the upside, 39.3% to the dark side out there, which is kind of interesting. We also have our actual question of the week right now, listeners, which is live right now. You can go play along at Options on Twitter/X to make your voice heard. Quite simply saying it's convention time here in Chicago once again. DNC 2024 kicked off as of Monday when we posted this, which raises the question, do you expect the convention to have any material impact on volatility and markets this week, or is it just another dog and pony show? Yes, it's going to move the VIX, going to move the SPX, or no, just a dog and pony show. Here we are, day 3 now, kind of getting our answer. But Mr. Dan, what is your vote? Which way do you think our audience went?
Well, no, I don't think it will, because it seems to me that like the conventions, I don't know, seems kind of pointless because I'm not a politic guy, but it seems to me that in election years like this, the national conventions are just to say, here's who we're electing as our candidates. And I think we all know who that's going to be. It sure seems that way. And so then it's just a bunch of people getting their chance to be on TV and boost their political standing within the party into the power base. I don't see that having much to do with the market or the volatility of the market.
Yeah, kind of a boring one this year. There's no drama. Who's going to be the VP choice or any of that fun? It was all settled kind of before they went. And people were thinking for a while, it might be an open convention here in Chicago, which would have been hearkening back to the old days of the political spec. Would have been a battle. Damn, that would have been interesting. But yeah, you're right. This is just a dog and pony show. At least that's what I say. Our audience agreeing 78.8% right now saying no impact on the markets. 21.2% saying yes. You got till the end of the week to make your voice heard out there, listeners, as we kind of come up against it. We'll get out of here on this question. Kind of an interesting one. Might have more to say this on a future show. Let's go to this question from Dream Team. I like the handle. Maybe they were a big fan of Olympic basketball this year. I don't know. Dream Team. Maybe they're a fan of 92 basketball. Either way, they say, what are Mark's and Dan's thoughts on trading 0-day butterflies? I've started to get into them lately, especially toward the end of the day. Are you guys down? Are we down? I know Dan's pretty down on the 0-day flies. This, again, I was just talking about this on our Pro Q&A earlier. I've started to look more into that spectrum. I haven't been pulling the trigger on them yet, but I have the feeling this is going to make fodder for a good episode in the future. Mr. Dan, do you concur with that sentiment, sir?
Oh yeah, man. 0 days. That's one of our most popular scanners that we offer is 0-day scanner. Yeah, first of all, like you just look at the numbers. It's like 50% of the SPX volume on a daily basis. 0-day options are one of the most actively traded. So, I don't know. you don't even have to ask me and Mark. You just look at like it. If there wasn't an opportunity there, people wouldn't trade them. Like that's just how trading works.
So yeah, not to cut this question short, who was that Dream Team? That's a good question. So much so that I think it's suitable for investigation on a full episode, hint, hint. So maybe stay tuned for some fun coming down the road pretty soon. A Mr. or Mrs. Dream Team about all things 0-day butterflies. Do we like them? Do we not like them? How do we use them? Again, interesting fodder for the show. Great question. We will explore it in more detail on a future show. Don't want to do it short shrift now because we're coming up against it. We want to really devote some time, sink our teeth into it. So we will do that. In the meantime, Mr. Dan, while they're waiting for us to sink our teeth into stuff, if they want to reach out to you with the question you asked before or any other questions, where should they go? What should they do?
Yeah, definitely come on over to markettaker.com, 2 T's in a row, click on join free, and hit me up in the chat room. Like, let me know what risk management tools are the most important to you, and take advantage of some of the free classes and free videos and other things we offer on a daily basis there as well.
There you go, markettaker.com. Don't forget the second T for Theta. And while you're checking stuff out online, make sure you're heading on over to public.com, public.com, the place to go to kick the tires and light the fires on their brand spanking new options platform. Also, these are tough times. The pennies matter. So if you want to get paid to put on some options trades, Public's got you covered there as well. And they're also looking for your feedback, your input on that brand spanking new platform. What do you like? What do you want to see them increase and add more of? All that feedback is valuable. And of course, tell them you heard about them on the old OBC. That goes a long way to keeping Dan and I doing this show for another 302 awesome episodes. That's going to do it for us today. Back again tomorrow for our usual doubleheader. In the early afternoon, we got, of course, the option block with our buddy, the Flowmaster, and our friends over there at SIBO. After that, we dive into the world of futures options with our friends over there at CME, This Week in Futures Options. Friday, back again, noon Central, 1 p.m. Eastern, to hold court. Myself, a whole bunch of other fun, maybe Mr. Dr. Vix and a bunch of other fun special guests joining us every week on Vol Views to break down the week that was and is from a volatility perspective. And then one final time for the week, barring the city melting down around our ears, one final time for the week exclusively for all you pro cats and kittens. We're back for some options oddities. And yeah, it's been a good couple of weeks on the options oddities front. Not that they're all good, of course, but these last few weeks have really been turning it up to 11. So if you're missing out on options oddities, you're missing out. Check it out, theoptionsinsider.com/pro, the place to go to learn more. Then we're back again next week, kicking it off on Monday with the option block again, all the way through to next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.